शेयर के बाद वो ऑप्शन है हाँ कर दो प्रेजेंटेशन ऑन करो हाँ ये कुछ लेना ये तो
Hi Sharon.
Hi, Sharon.
So Sharon, we'll wait for 2 more minutes. 2 more minutes means after 9:30, we'll wait for 2 more minutes till 9:32, and then add everyone. Till that time, check everything.
And Sharon, आप अपना ना Teams log out कर देना, otherwise team will ping you.
And if any one of you have to reach out to me through Zoom. I'm logging out of the MS Teams. Mm.
Thank you. ठीक है?
Thank you so much, sir. You're on mute, Sharon.
Do you guys hear any background noise from my end?
No.
Perfect.
Hello, good morning, everyone. We are about to start, just waiting for one of our panelists to join.
Hi, Carl.
Good day.
Hi, Carl. Very good
Hello.
morning.
Hello, everyone.
Hi, Carl. Good morning.
Good. Good morning.
Very glad to see you, Carl, again today.
You look sharp today.
Oh my God, thank you so much.
Okay, so we have all the panelists here. So I think we are good to go. So hello, everyone. Good morning, and thank you so much for joining us today. It's so wonderful to see such a fantastic turnout. As I can see, people joining from East Coast, West Coast, Midwest, and everywhere in between. So what an incredible geographical mix. That truly shows how important and timely today's topic is. So my name is Sharon, and I am a client relationship specialist here at Global FPO. At Global FPO, we partner closely with CPAs, CFOs, and accounting teams to deliver end-to-end outsourcing support from bookkeeping and tax preparation to compliance management and financial process optimization. Our goal is simple: to help CPAs work smarter, faster, and with complete accuracy. So now, while everyone's getting settled in, let me quickly walk you through a few things that will help us make today's webinar smooth and engaging. So we'll be having two dedicated Q&A segments, one midway through the session and another toward the end. But don't wait until the end. Feel free to drop your questions anytime in the Q&A panel. And the readers' handouts have already been shared over mail, so all of you can take extensive notes. And for your information, this session is recorded for training purposes. So this is our today's agenda. Yeah. Just give me a second. Yeah. So now let's turn out our attention to why we all are here today, to discuss One Big Beautiful Bill Act, or as many are calling it, OBBBA. It was signed into law on July 4. This landmark act represents a significant shift in US fiscal policy, designed to boost economic growth and expand opportunities for businesses and manufacturers across the country. OBBBA covers several key areas, including business taxation, international taxation, specialized taxation, and individual taxation. And it also makes the 2017 tax cuts permanent, introduces new deductions for overtime pay, tips, senior social security income, and US-made auto loans, while increasing the standard deduction and child tax credit. So these all are the measures that are set to benefit millions of working and middle-class families. Most of these provisions come into effect starting the 2025 tax year, meaning they will apply returns filed in 2026. And that's exactly why today's session is so important, because these changes will directly impact the daily work of CPAs, from reporting the compliance to client communication, planning, and advisory roles. So over the next few hours, we will dive deeper into what these reforms mean for both businesses and taxpayers, and most importantly, how CPS can adapt to stay ahead of the curve. And to help us unpack all of this, we have an incredible lineup of speakers joining us today, each bringing a wealth of experience and perspective to the conversation. Let's begin by welcoming our first guest key speaker, that is Mr. Carl Jaycox. Carl is the CEO and founder of 40 Strategy and 40 Accounting based in Oregon. He has led 7 organizations and each grew between 2 to 7 times with operations across 4 continents. That's quite an achievement, I must say. Apart from this, he's also the author of Lost at CEO and host of the popular Measure Success podcast. Carl is widely recognized for helping leaders think differently about strategy, execute with clarity, and achieve measurable success. We are thrilled to have you with us, Carl, today. And I will, I think you can take it over from here, Carl. So the floor is yours.
Perfect. Thank you so much. It's a pleasure once again to everybody to be here today and to talk through this bill. Thank you so much to Global FPO to invite me to be a part of this panel. So thank you for that. And you'll be driving through the slides. Is that correct? So we go ahead and move forward on the next slide. That'd be great.
Sure. I can run that for you.
Thank you. So let's go to the next slide. And so one of the things that should not be underestimated is the value of the OBBBA Act that has come through. It's extraordinary. It is a huge opportunity for small business owners and for individuals to use the tax incentives properly to help accelerate and advance your business. And so I'm very excited about things that we'll be talking through today. And the first thing we're going to talk about is something is the permanent expensing of R&D. And one of the things I want to talk about this is just briefly, my experience with this goes all the way back to 1996, which is a long time ago. I was working with Coopers and Lybrand, and actually was my very first experience of working on an R&D tax expense thing. And it was amazing the value it created on being able to do that. What's great about the new provision is it's finally back. Frankly, for the past several years, it has not been as valuable, but now we can actually properly use R&D to actually helping out organizations from that. So go ahead and go to the next slide, please. So starting this year in 2025, business can immediately start expensing domestic R&D cost instead of amortizing them over several years, which is a huge value. Frankly, in the past, you were sometimes losing money using the R&D tax credit, which was not very valuable because now you could actually expense them all immediately. And so this reinstates the full expensing for US base is really critical here. Research and innovation activities. And it's really the goal here is to help support small business. So this is a great opportunity to help once again to start using R&D. If we go ahead and go to the next slide there. So what does this mean and how to use this? The good news is it includes in-house research, contract research and development, and software development costs conducted in the US. One of the things that's really important here to talk about is actually it helps out with even using AI. Most small businesses now are applying artificial intelligence in some way, shape, or form, whether you're improving your process and procedures, perhaps you're literally using ChatGPT as a tool to help improve your process. If you document what you're doing, these type of efforts are potentially deductible under the R&D plan now. So this is, in the past, once again, it sometimes was hard to qualify for this because you didn't actually have what would be called a process of experimentation of fixing things, but now we do. And so this is a huge value behind this. If you use foreign R&D costs, it still has to be amortized over 15 years. So once again, the focus of this should be efforts and expenses that are happening with employees or contractors that you're directly using in the US and costs you have behind that. And also small business may amend prior returns to 2022 and 2024 and apply the new rules. Of note, I'll just say this. There's a little bit of a red flag if you do that. Going back retroactively to do the R&D tax credit, you better have your documentation nailed down. So I highly recommend that you work with a professional to make sure that you have your R&D tax credit properly. So proper documentation that you show behind it. Don't just put it on a line, because there's a high degree of likelihood if you go back the 3 years and retroactively apply that, you have a risk of being audited a little bit higher than normal. So that's the only thing I'd suggest if you're going back to do the retroactive part. But definitely take advantage of you applying the rules today. And once again, non-qualified research, ordinary testing, adaptation of existing products, that doesn't count. Okay, this is in terms of where you're doing new type of work that actually qualifies as research. And you want to be able to, and you can't do capitalized R&D costs that don't meet what's the Section 174 criteria. So you have to make sure you exclude what you can't do within it and then include what you properly can. Let's go ahead and go to the next slide there. So you see here in form 6765, this is the new form here for the credit for increasing, or actually the existing form, December 2024, this revision came out, the credit for increasing research activities. This is where you'll be putting in, you can see there's a regular credit approach you could do, or the alternative simplified credit. Once again, the key around this is when you have your information and documentation, you want to put the information in here. And I think once again, just to clarify this so everybody knows, the value behind this is an actual tax credit, meaning the government is giving you money back for work that you've already paid. And that's, once again, the value of the R&D tax credit versus other things, which is just you're getting a qualified deduction for. Let's go and move to the next slide there. Perfect. Okay, thank you. All right, the green energy policies, if there's any loser in the tax bill, it's the green energy policies. Honestly, nearly everybody benefited, but people like Elon Musk, et cetera, they did not benefit from this. Anybody who is solar panels, energy, electrical vehicles, some of the things have already expired. And matter of fact, by the end of the year, a lot of them will be expiring here soon. So let's go ahead and go through some of the details behind this. So once again, the framework around the green energy policies, basically they've tightened this up and they've reduced the application and availability of what's actually out there. And so there's definitely incentives. There has been incentives in the past about domestic production, cost efficiency, energy independence. But the reality is most of this, all of these things have been phased out after September 30th and December 31st. So for example, the car energy credit, if you're planning to buy your Tesla and getting a tax credit today, you will not get the credit that you used to if you would have bought it back in September 30th. Other things that are phasing out, for example, coming out is solar panels for your house. That is phasing out at the end of this year, in December 31st. And so unless you have these activities happening, it's going to be hard for you to be able to get those reductions by the end of 2025. Let's go to the next slide, please. So I suggest a few of these once again. So the new clean vehicle credit, gone. Use clean vehicle credit, gone, right? Both of those things are literally no longer available, as well as the qualified commercial clean vehicle credit. So these, once again, are the negatives behind the new bill that took place. Obviously, there is differentiated opinion. I'm not saying right or wrong, but these are, once again, one of these areas that's not a value anymore that there used to be. And there's also, as you can imagine, an impact on used vehicles now that are electric vehicles. Now, if you may see on the road, you've probably seen a lot more electric vehicles, Teslas on the road as of 9:30. Why? Because people were taking advantage before it phased out, but now it's gone away. And so a lot of actually manufacturers are deciding whether or not they're going to keep on manufacturing in the US electric vehicles. And so just keep that in mind when considering getting an electric vehicle going forward. I'm not saying you shouldn't do it. It's just the tax credits that are available are no longer there. Let's go to the next slide, please. There's also, unfortunately, the expiring home energy credits. So no longer will the credit be allowed for any property placed in service after December 31st, as well as the residential clean energy credit. Both of these are no longer be allowed after December 31st. So if you have the ability to be able to qualify, you literally have, as of today, about 21 days left 3 weeks left to get in anything that's going to qualify for these credits. And it will be hard because a lot of them, of course, are already backed up, but people are aware of the bill. So these are, once again, things to keep in mind. And it's very limited compared to what it used to be in the past. Let's go to the next slide now, please. And then in terms of, okay, question here. Will a taxpayer qualify for the credit if the property install has been used by another individual? No. Yeah, so used property is definitely not eligible for the credit. Great question. Next slide, please. Another two is it refundable or non-refundable? And once again, unfortunately, bad news with this. The credit is not refundable, personal tax credit, and you can only use it to claiming a taxpayer claiming a non-refundable credit can only use it to decrease or eliminate a tax liability. The taxpayers won't receive actual tax refund for any of this for the credit that exceeds the taxpayer's liability for the year. Next slide there. In regards to AMT, yes, a taxpayer is subject to the AMT and is eligible to claim the credit and may offset the AMT with the credit. So that is a positive that you can actually end up doing. And then next slide. And then here is the Form 5695 to properly, once again, qualify the residential energy credits. Keep in mind, once again, the big issue here is please, if you're considering of doing something, make sure it's completed by December 31st. And unfortunately, once again, if you're going to buy a car vehicle, not as advantageous as it was, these are when you actually want to consider doing other things, such as getting a vehicle that has over 6,000 gross vehicle weights, where you can be able to combine depreciation and the 100% bonus depreciation to potentially get the whole vehicle to qualify by end of year. That's where a lot of people are moving to right now, as opposed to buying the electric credit. You still can do electric vehicle. The reality is most of them over 6,000 gross vehicle weights, but you're not going to get the additional energy credit on top of that. Wonderful. All right, let's move on. Section 529 plans. Let's go to the next slide. Okay, so once again, for those who aren't familiar with the 529 plan, it's of course a tax advantage savings plan that's intended to help out families save for education. Good news is earners grow tax-free. Withdrawals are tax-free when they're used for qualified purposes for your for college, such as tuition, fees, books, equipment, etc. And so it's a great tool to be able to help defer income that goes into when you're considering saving money for your children's college education. And so or also for grandparents to help put in money into a 529 plan for their grandchildren. These are, once again, opportunities you could do to help create opportunities for people to save and have this value around it. So let's go to the next slide. So the good news for this is it increases significantly. K-12 annual limit increases to $20,000 in 2025 compared to $10,000 in 2024. So once again, how can you use these expenses? It includes effectively, actually, let's pop back to the last slide there. It does include curriculum, online materials, tutoring, test fees, and even therapies. You can see there's quite a few things it qualifies for, licensing, and you could also do rollovers to able accounts. It can make it permanent, or you could also use it for Roth IRA. That's one of the concerns people have sometimes of moving into the 529 is, what if they don't have to use it? What if their kid ends up getting a scholarship? Well, the good news is there are ways to be able to roll over the income without having a significant tax hit behind that. All right, now let's go ahead and go to the next slide. Okay, now you can see here a nice table here, kind of the before and after. So first of all, the big thing is so much more money you can put into it. It goes from 10 to 20,000, right? That's a significant difference for people who are looking at putting in a 529 plan. The second part is the K-12 qualified expenses. Ultimately here, you could put, beforehand, it was more focused on tuition. Today, it's much more expanded into tuition, curriculum, books, online materials, test fees, etc., dual enrollment, and even certain therapies, which, that's even a deeper level of like what you once again, always make sure you're talking with somebody as to what that means and getting more detail behind it, but much more valuable beforehand. In the past, if you look at the vocational credit licensing, really difficult in the past to actually get that qualification. But now there's things that are explicitly included as known as supplies, equipment, exams, continuing education, as an example, right? These are things that are all available. And then you can also see here behind the rollovers to ABLE accounts. They were allowed. Now they're made permanent after December 31st of this year. And then rollover IRA rollovers from 529, there's no change in that. So anyways, the good news is there is opportunity to be able to do that. As you can see, there is a limitation with $35,000 lifetime of being able to, it's capped at that amount. But good news on the 529 plan. Let's go ahead and go to the next slide. So once again, what are the real positives and advantages behind it? Well, if you have money in your own personal account and a taxable account, and it's growing there, it's going to get taxed, right? But when you do put it into a 529 plan, it's going to grow tax-free. And you're going to get to pull it out for qualified expenses not being taxed on the growth that happened. So that's super valuable behind it, right? Actually be able to, especially if you do this long term, right? If you're really thinking thoughtfully, the best practices, great strategies, right? You have a brand new kid, start putting money into a 529 plan today, right? College tuition is not going to get any cheaper in the future. It's only going to get more expensive. So considering putting those expenses into it, the good news, they'll grow tax free. The only negative, I'll just say, of putting in a 529 plan is they're going to count that 529 towards money that you have to be able to contribute towards college education. It's a little outside the scope of this discussion, but when it comes to FAFSA agreements, if you're familiar with that, that's the financial aid forms for student applications. When doing that, when applying for that, they're going to count that 529 as available money for that. So there's a pro and a con behind that. So if you're trying to get underneath a certain level of not being taxable, that's anyway something you have to consider and a risk around that. But generally suggesting if you are not trying to get help by the government or by a college institution, use the 529 to help be able to grow tax-free behind that. One thing to note, it's not tax deductible. So even though you can put $20,000 into there, you can't deduct it on your tax return, but you are eligible to put up to $20,000 into it, once again, which is a huge advantage that compared to what it used to be. All right, let's go to the next slide. And this is a nice thing is you can actually open it up for anyone, right? So anyone, including yourself. And so that's another value behind it. There's actually no income limits and no limit to the number of plans you can have. So this is a great way. Let's say you're just a very generous person, or perhaps you're a grandparent and you have multiple grandkids and you have the ability to be able to put money into it. This is a great way to, if you were considering gifting or getting money beforehand, this is better than gifting. Because why? Because you could then end up growing that money tax deferred in that account. And then they could pull it out tax free. So that's the value behind it. So you were actually investing for them, you may have done anyways. And then you could actually gift it towards your children, grandkids, and then you get that exclusion of the interest and income that you may have been making anyways, but that's not going to be counted in your normal tax return. All right, let's go to the next slide. So change the beneficiary to another family member also doesn't cause issues. So we have 4 kids and we've had 529 plans and they've had varying levels of scholarships as they gone into. So one of our 3rd kid ended up getting into the U.S. Naval Academy, which was really cool. The good news for us is we didn't have to pay for his education at that point. So we were able to have other funds pushed down to our 4th kid who now we also were fortunate in that particular case. She ended up getting once again, these are like not the typical things, but she was able to get somewhat of a college scholarship for soccer. So we might have this situation where we have excess funds, but the good news is we have the ability to be able to roll it over without having tax consequences. So once again, you shouldn't be fearful like there was in the past where things are a lot easier than they used to be on being able to do that. So once again, you move it over tax-free, penalty-free, and you could transfer the funds from your child's 529 to even a sibling's plan, once again, without penalties. That's the key thing to know about that. All right, let's go ahead and change the next slide, final slide here. This is what you're going to see from the payments from the qualified education programs, is which go to Form 1099-Q. This is ultimately is that you'll get this information when you're actually paying qualified money for education and being able to use that properly out of a 529 plan. This will help make sure it's qualified and you don't have any taxable consequences when moving forward with that program. Okay. Let's move on to Section 179. This is really good news. Section 179. It's expanded significantly from last year. Let's go to the next slide, please. As mentioned, it's gone up a lot, and you can immediately deduct the full purchase price of qualifying business equipment and certain property in the year it was placed in service rather than depreciating it over several years. So this is, once again, super valuable. It provides immediate tax savings for businesses, and you can invest in a new or used replacement equipment. And it also applies to vehicles such as vehicles, office equipment, machinery, computers, and assets. So if you're in the situation, this is kind of the big summary here. If you're in the situation, you're either consulting a client in taxes or you personally are in a tax situation, you really want to be looking at their tax estimates right now. And if they have significant taxable income and they need an asset and they're planning to buy it next year, definitely look at buying assets that are of value to save them today, especially if they're in a high income tax rate. You know, we worked with a client recently. They were in between the $400,000 and $500,000 of taxable income. That's a really bad situation because basically between $400,000 and $500,000 of taxable income, a lot of the benefits they start phasing out, personal exemptions, et cetera. And so your effective tax rate in that between 400,000 and 500,000 is going to be a 35% federal tax rate. If you add in some states that have a 10% tax rate, that alone can be a 45% tax rate, right, for an individual. That's significant. So if you are looking at buying materials, it's literally a 45% discount on buying assets and getting the full deduction this year. And beyond that, you can actually take a loan, purchase equipment, and still get the benefit. So a client that we had actually bought a vehicle that was under a certain amount, purchased it, got a 0.9% loan, which isn't common. It's not always advertised. Basically, almost like free interest, right, over a period of time. And they got the full deduction of that vehicle for this calendar year. Now, of course, there's different roles of vehicles, which we'll go over and things to be considered, but let's go ahead and go to the next slide here. All right, so this is a big deal, right? Once again, depending on how much income that you have or your business are running through, it's gone up to $2.5 million for 2025 compared to 1.22 million. So you have the ability to actually put a significant amount into purchasing and being able to use the Section 179 expenses. The phase out threshold, the phase out for the deduction when the total cost of qualifying product exceeds 4 million, went to 4 million, increasing from 3 million. So once again, another example of we have more abilities to be able to deduct taxes with Section 179 and take advantage of it. All right, let's go to the next slide. Now, this is important to note. Personal use property, meaning like, you know, an argument whether your cell phone is personal use or not, that might be an example of something personal use, or real estate property is excluded from this. And also the assets have to be placed during the actual, not placed during the tax year, are excluded. So they actually have to be being used. And the total deduction cannot exceed the business taxable income for the year. If your goal here is to like get losses in your business, that's going to carry forward that loss of the Section 179 and roll over to a future year. All right, let's go to the next slide. So to get the Section 179 deduction, the property must be qualified as eligible property. It needs to be bought for business use, right? Should be purchased, not gifted or inherited. And also, there's a whole list here. We have which this would provided property that does not qualify on the IRS. So once again, it's to be very thoughtful about the type of property that does and doesn't qualify under Section 179. All right, let's go to the next slide in question. can I deduct more than my business income? We mentioned that earlier. No, you can't deduct more than your taxable income for the year. So once again, you're not going to be able to drive losses. Anything that you use for that is going to be carried over to future years behind that. So as noted there, any unused amount. All right, so the next slide. Okay, if I buy qualifying property with cash and trade it in, what is the treatment under 179? All right, so let's say in this example here, so the key is it only includes cash paid for such qualifying property. If you buy with cash in a trade, and it's a cost. So this is a really interesting thing. Actually, I had a client just talk to me about this, and they were saying, "Can I trade in my vehicle?" Okay, this particular situation, can I trade in my vehicle and buy a new vehicle with that? So I'm going to keep numbers simple here. Let's say it was a $100,000 truck that they were purchasing, and they were trading in a $20,000 vehicle that was already fully depreciated. Let's assume for simplicity's sake, we could deduct it all. From the vehicle standpoint, you could claim the 100,000, but you have to claim a gain on the $20,000 trade-in. So they're considered two separate parts. You can't take one and get the other. You actually have a value that goes behind it. So this is one of those cases in tax law where there's some logic behind it. The goal here, if it feels too good to be true, it probably is. So if somebody's saying, "Oh yeah, you can sell an asset, not have any value." Now, if you gave away, if you had zero value and you depreciate it and you salvaged it and nobody got any value out of it, that's different. But if you're trading it in or selling it, you actually have to get. So basically, you get the net difference between the two, and that's just one of the things that's important to consider behind how much you can qualify for Section 179 or not. All right, let's go to the next slide. Okay, and as good old our favorite form 4562, depreciation and amortization. And once again, it's really important to make sure you have good documentation. One thing that I just didn't stress earlier that I think it's just super important to know is that in tax law, documentation. There are no tax loopholes, folks. But when you don't document properly, you're at risk. And so what's super valuable is like, even if, for example, if something that is a property that you're purchasing and you want to validate it's being for business use. If you have a vehicle use, you want to validate it's for business use, right? You want to make sure that there's documentation around that. If you have documentation and there's an audit, you're at less risk of having anything come back. But if you just try to make decisions that don't have proper documentation behind it, that's when you're at risk. Our whole mode whenever we're working with clients is we're to sleep at night, right? That's our whole mode, right? And so if we sleep at night with working with our clients, we feel good about it. How we sleep at night is good documentation, right? And a business purpose behind it. When we start seeing things being blurred a bit between personal and business, document to make sure that it can qualify for business use. All right, let's go to the next slide now. Okay, bonus depreciation. Once again, it's back and better than ever. So if you recall, many years ago, the bonus depreciation came in, and there used to be, it was getting down to 60% for 2024, is about to move down to 40% for 2025. The good news is now bonus depreciation is back to immediately deduct 100% of this of qualifying property in the year is placed in service, and is now made permanent under the law. So this is really, once again, really advantageous, valuable news of, once again, of most things you're buying that, and let me clarify this, for larger businesses that are doing GAAP, you still might be depreciating from a book depreciation an asset over multiple different years. But from a tax basis, you're going to deduct that. You're going to be able to deduct a lot of this fully up to a certain amount that's qualifying property. So this is good news. Once again, you don't have to wait, right? It's the value of depreciation and be able to get use behind it. All right, let's go to the next slide. So property behind this, once again, there's a bunch of details on what are qualifying assets in terms of makers, but ultimately there's computer equipment, office furniture, and machinery. These are all qualifying under 28 years. Residential rental property identified through a cost segregation study. So that's really important. Once again, hopefully you out there are doing cost segregation studies with your clients if they have a building asset that's at least $250,000, $300,000. Why do we do that? Is to help bring assets down from 27 and a half or 37 and a half years to under 20 years. When it's under 20 years, we can use the bonus depreciation to be able to recognize 100% of it. So that's the value. And once again, of being able to use that to pull stuff out that traditionally you'd be depreciating over, once again, 27 years or 40 years. You can get it to be much, and often we see with a cost segregation study, you typically can get, you got to be careful with this as a rule of thumb, 30 to sometimes 40% of the building you could bring it down if done properly. There's what's called a CPA study as well as an engineering study. By using one of the two of those, we try to use engineering studies as much as possible, but we also do CPA studies. Either way, it's a great way to bring more depreciation. Why is this valuable? You can get positive cash flow at a company, but through depreciation, you're actually not paying taxes. This is one of the best way to help defer income is through depreciation. All right, let's go to the next slide. Once again, what is period with over what you can't do? If it's over 20 years, you can't do it. So if you were buying a building, that's either like a rental property or commercial property, it's not going to qualify. So that 100% bonus depreciation will not unless you cost seg it out. Assets used prior to acquisition by the taxpayer, okay, it's not going to apply. So it has to be for new assets. Non-qualified real estate personal use doesn't work. And then there's certain states that's not conforming to federal bonus depreciation that you have to be mindful of. New York and Illinois are a couple examples of that. Okay, here we are. Got to take a breather here. Charging along on business provision, tax provisions. And we want to talk about the pre and post impact behind this. Let's go to the next slide. So this is summarizing what we've been talking about today. And let's take a look at the value behind using this pre and post the changes. So beforehand, we had limitations on expensing, for example, of R&D. It's 15,000, 31,000 under that. Now, though, post the law after the changes, it permanently restates immediate full expensing for domestic R&D cost. Once again, I want to reiterate R&D cost, if documented properly, things such as using AI improvements can potentially qualify. And this includes your own wages if you document that you were working on these projects. This is the value, once again, of an R&D tax credit. So, and specifically, you have retroactive relief. Once again, you can go underneath if you have gross receipts for businesses under 31 million. So that's going to qualify for most small business. Huge value there of being able to use that. Green energy policies. Once again, this is the big loser in the law. Just basically, it's just not. They're almost all gone by the end of their nearly. Once again, unless you have something actively that's going to be placed in service, or you'll be spending money towards it by the end of December 31st, it's not going to qualify. 529 plans have moved up significantly. You now can do up to $10,000 more beforehand than you could in the past, and plus way more qualified expenses than we had. And then finally, of course, Section 179. Love it. Right? We get to from 1.22 million, deduct it to phase out. It goes way further than beforehand. Now we can deduct it to $2.5 million with a phase out at 4 million. So once again, huge opportunity there with Section 179. Next slide. And then ultimately here, bonus depreciation, as mentioned beforehand, really valuable. It was going to go down to it was 40% in 2025. Now it's back to 100% bonus depreciation. Okay. I think that completes our summary of our things we're going to go through there.
Yeah, thank you so much, Carl, for those valuable insights and for walking us through business taxation. That was truly enlightening. And just to let everyone know that it's time for your questions. If something's on your mind or you would like to dig a bit deeper into today's discussion, go ahead and type your question in the chat box. We are up for Q&As.
Hi, Carl. I think we already have 3 questions, so probably you can see them in the Q&A section and you can answer.
Yeah, perfect. So I think the first question is related to handouts. And I think, Sharon, how are people going to be able to connect with that?
So post this session, we can connect to all the people and then we can share the handouts.
Yeah.
Perfect.
Well, I'll
Jamie,
take.
you had a question. Oh, I'm sorry. Go ahead.
No, sorry. So I'll take care of the handouts. You can take the questions now.
Okay. Thank you. Thank
Yeah.
you. Okay. And then the other questions I see in here, at least in the chat, are there any waiting periods for the 529 plan? Let's go through a few of these things here. Let me go to the third one beforehand before I go to the waiting. So what do you mean by a waiting period? Are you saying, can you just put it in, put it out? I guess that's the question behind that. So Jamie, if you could provide a little bit more clarity, or you refer there, but generally speaking, you could put money into the 529 plan and start using it tomorrow for something else. So there's not intended to a 529 plan. The problem is you're just not going to really get any benefit behind it, right? So if you are literally going to pay for your child's college education with current funds, there's no reason to use the 529. As mentioned beforehand, the problem with the 529, this is the only problem with the 529, is that it will be counted more heavily in your FAFSA calculations for how much student aid your child may get. And so, or your client's children may get. So that's one of the things that have to be thoughtful around that. Jamie, additional question there. Does the grandparent get to deduct is a gift to fund the 529 plan? It's not considered a gift. So that's the good news, right? It's separate. It's a separate policy where you put in a 529 and then there's a beneficiary. So it's if you may, it's in addition to being able to put it. So there is value behind that. So let's say, for example, you had a grandparent that they were planning to give a gift, like directly, they can do a gift and then they can separately do 529. So there's some values behind that on being able to help give more and have it not be, once again, taxable. All right, other questions here. Great question here. Anonymous attendee. Okay, let's go down to the bonus depreciation question on the vehicle. Can you, on a vehicle, purchase it in your personal name, but it's for your business? Okay, so technically speaking, you want to do everything you can to have the business asset be named under the title of the business and all when possible, right? And you want to have the insurance and you want to have everything being purchased directly from it. However, you can have especially if you're a closely held business, it's sometimes they won't allow your quote unquote company to be the title of it, depending on who they are. And so you could have it be personal, but then you're still going to put the personal asset into the business when you do that, right? And so you can still have it go through behind there and then basically insert the vehicle. You want to make sure that the expenses, though, ideally are being paid all by the business. Now, where people get in trouble in audit situations is when they don't document their business versus personal mileage. Just because you bought it and you got 100% depreciation doesn't mean you're potentially not at risk of having personal income use of your vehicle. So we highly recommend whenever possible to continue to track business mileage and actual expenses behind that. The other way you could do, of course, where you don't get as much value is using the mileage method of being able to just track and do business expenses on a mileage basis. But once again, whenever you can, try to have everything be titled properly, insurance properly, and it's being used for businesses being documented for a business. I heard recently, this was not our client, but somebody who bought a new vehicle every year using 6,000 gross vehicle weight. and they did 100% bonus depreciation. Well, they had some limitation on the rules in the previous years. They got audited, right? They were pushing the envelope, and it wasn't a good story. So you want to make sure, once again, you're being rational and reasonable with it. And this was, by the way, a standalone business, and they're working out of their home, and they didn't have any show of business moving to anywhere. So that's why they got audited, and they ended up having basically they weren't able to get all the depreciation that they thought they were going to get. So use it properly and to get the right bonus depreciation out of it. Okay, let's see. Is there any additional questions? Yes, Jamie, I agree. The 529 gift plan, it's outstanding. So great opportunity there to help use once again for those who are planning to provide and give. There's good opportunities around that. All right. Any other? Looks like we've got our questions there. Anyone in the chat? We'll be happy to answer.
We can wait for another 2 minutes if anyone comes up with any question.
So, Neil, I know you're getting ready to talk here in a minute, and your part.
Absolutely,
What are
Carl.
some of the challenges that you see when you're working with clients on that business vehicle? Well, what are some guidelines you recommend when somebody's trying to deduct a business vehicle?
So, Carl, in this case, what we generally ask the client is the business miles. What are the business miles that the client has driven? And if the client has bought a new business vehicle, then definitely we would ask the client for the cost of that vehicle so that if we can take it for depreciation or anything. Main thing is at Global FPO, what we try to do is we tell the client that how we can benefit them legally and within the tax law, tax ambit, how we can help our client with the strategies of reducing their taxes and providing them the best services. So these are some kind of things which we generally do in terms of the question which I have asked, Carl.
And just a little tip, once again, that a lot of people aren't familiar with. It's like, so how do I track my business mileage? People think of the old way of having a piece of paper sitting by their car and they're writing down the beginning mileage and ending mileage. This is the good news, folks. We have technology these days. There's a tremendous amount of applications that will automatically track your mileage without you even touching anything. All you have to do is after you actually do a trip, you have to then notate what it's related to, if it's business or personal, and what particular business was it doing. I personally, a lot of our clients use QuickBooks. I use QuickBooks personally for my businesses. Why the value behind this? I have the QuickBooks app. The QuickBooks app, that's one of the only few things I keep on to allow to track me at all basis. Why? Well, I drive around regularly, and because of my businesses, I consistently have business conversations when I'm going to different locations, meeting with clients, prospects, etc. So, as a result of that, I can qualify a lot of my mileage for business mileage, and therefore I have a high opportunity for getting full deduction as a result of that. It's easier because I have it automatically being tracked. So I highly encourage people who are looking at doing the business using business vehicle and having that purchased. Now, if you're not using it for personal use at all, it's easy, right? If you truly have a truck and it's 100% being business use, you don't have anything to worry about, folks. Okay. What I'm talking about here is where it's effectively replacing your personal use vehicle. And you may use it from a personal side, you may use it for business. That's when, once again, you just have to be thoughtful about how much percentage of that can you use for business versus personal. And so, for example, you might determine that you have an 80% usage of the vehicle that's business and 20% that's not. So one of the things to do is just claim 80%, right, of deduction against it, or the vice versa is claim 100%, but then you have the risk of a 20% of that being personal income. That's basically the options you have around it. By the way, that's better than zero deduction. So that's, again, take it, use the law properly with proper documentation to maximize your deductions as allowed by law.
Absolutely agree, Carl.
Well, thank you so much, Carl, for sharing your valuable insights. And I think this is it. We have covered all the questions from the audience. And we truly wish you could stay with us a little longer or till the end, but we completely understand your schedule. So we have really enjoyed having you with us. And thank you once again for being part of today's discussion.
Thank you. Yeah, it's been an honor. Thank you so much. And I will say just a positive here. We are partners with Global FPO. That's why we're on this. They've been a great
Yes.
partner for 48 Counting. We have a very a great relationship where we help each other out effectively with our tax matters, helping out with our clients, helps us to work 24 hours a day, so to speak, and help with the real challenge, right, of having resources that are available. And so they've been a great partner for us. And so if you are considering and you aren't using Global FPO today, I encourage you to consider that to help scale your business.
Indeed.
With that, I'm out of here, everybody. Have a good one. Enjoy the rest of the presentation.
Thanks, Carl.
Thank you so much, Carl.
Okay, so and with that, we can take a quick break before we start another section, that is international taxation. So let's take a quick break of 5 minutes and we'll be back right here in 5 minutes. Okay, so welcome back, everyone. And now for this section, we have Mr. Anil Bhatia, Director of Tax Operations at Global FPO. So Anil brings more than a decade of experience in US taxation, having spent 12 years with a Big Four firm renowned globally for its excellence in tax, accounting, and advisory services. His expertise spans compliance, tax planning, and business taxation, and he is known for his precision and client-focused approach. Anil continues to play a key role in strengthening global FPO's excellence in tax operation. And from here, he'll be leading the webinar. So over to you, Anil.
Thank you so much, Sharon, for impressive explanation. And I would like to thank Carl also for explaining on such a crucial topic of changes in terms of business taxation in OBBA era. So thank you so much all for joining the session. And today I'll be discussing on the changes in terms of international taxation in the OBBA era. So I'll be throwing a quick glimpse on the foreign tax credit in this international section. As you all know, that OBBA is signed into the law on July 4th of 2025. And it introduces the most significant overhaul in the US foreign tax credits regime since the 2017 Tax Cuts and Jobs Act. So what I would like to focus out here on certain key related provisions and their implications on the taxpayers and the corporations. So as you know, from looking at into this slide deck, is that effective 2025, the foreign tax credit lets the US taxpayer to reduce the US tax by the foreign income taxes they paid. It is always dollar for dollar. And interesting thing is that it will increase the FTC utilization, which I'll be discussing more in detail in the next slide. The FTC, this update, it prevents the double taxation of foreign earned wages, dividends, and royalties. And with this OBBA Act, it simplifies the reporting rules to make the compliance easier and clearer. Now, guys, we'll come on the eligibility part, like who all are eligible to take this foreign tax credit. The first and the foremost thing should be that the person must be the US citizen or the resident alien with the foreign sourced income. Then only that person can be able to take the benefits of the foreign tax credits. Another eligibility criteria is the legal and the actual tax liability. As I and Carl also listed, that all of the benefits, they are there in the IRS rulebook and the RevProcs. But the main thing is that we need to make sure that ethically we are claiming those deductions or the credits. So the foreign tax credit in this case is also, this needs to be legitimate, compulsorily the income tax, and not a voluntarily or the reimbursable payment. That we should make sure in that. Another criteria is that the income, it should also be taxed within the US. What does that mean? It means that the income on which the taxpayer has paid the foreign tax credit, that must also should be subject to the US taxation. Otherwise, we know that it will not be allowed to take the credit. So certain major changes, as I said before, it includes the expense allocation relief. What does that mean? So the interest and the research and development expenses in this, they are no longer allocated to the section 951A. There's the section 951A. So in under that basket, it will no longer will be allocated, which means that it would preserve more foreign source income for the FTC purposes, right? Next thing will be the increased FTC utilization. So in this case, the deemed paid credit for the net controlled foreign corporation, which we would also term as NCTI, the net controlled foreign corporation tested income. Earlier, it was known as the GILTI, the global intangible low taxed income. So there is a massive shift from the prior year. Thus, basically, it rises from 80 to 90%. So what does that affect on the taxpayers or the businesses? So what it would do, it potentially eliminate the residual use tax on the high taxed foreign income. So with this massive shift, I would say that it will help the businesses on that. And I would like to pay a quick focus on the new sourcing rule also. So basically, up to 50% of the income from US produced inventory, which is sold abroad, may be, which I again reiterate that it may be treated as the foreign source. So offering not full but partial FTC relief. So what I would always say in this case is that the taxpayers should begin evaluating their structures. By structures, I meant that the business structure or the business composition into their businesses and the strategies at this point of time where we are sitting to optimize their FTC outcomes under the new rules of the OBBBA Act. And please note that this will generally apply to the tax years beginning December 31st, 2025. So on this slide, I'll be discussing very quickly on the exclusions. So please note that this is, or there's no change into it. It is already similar to the prior years. So the foreign taxes that are refunded, reimbursed, or credited back, we know that they are not eligible to claim the foreign tax credit. Second is foreign tax credit is not refundable. It can reduce the tax liability to zero, but it cannot result in a refund. And we cannot claim both the deduction and the credit at the same time for the same foreign tax. So we need to make sure on that. So here's the quick summary of the foreign tax credit, which you can look, which we have already discussed on it. And let me know in case of any questions. And here's the form 1116, where we generally update the foreign tax credit. This form is for 2024 because for 2025, the IRS still need to publish those forms. So that's why we have taken the reference of 2024 foreign tax credit form. Next, I'll be discussing on the individual tax provisions under the OBBBA Act. So majorly, what I will be doing is I'll be covering the section from the standard deduction till the tax bracket. And after that, Surya, my counterpart, he'll be taking care of the session on the individual tax provisions. So first, we'll be discussing on the standard deduction. A quick overview on the standard deduction. So standard deduction, it's a fixed dollar amount that reduces the taxable income available to all the taxpayers who do not opt for the itemized deductions. So as we know that the taxpayer may choose each year to either claim the standard deduction, which is the fixed amount that may be deducted against the income based on the filing status. Another update is that the OBBBA, it has increased the amount of the standard deduction across all the multiple layers of the taxpayers. Why IRS is doing that each and every year? The IRS increases these kind of deductions each and every year to fight with the inflation, which is also known as the inflation adjustment. So it is there on the slide deck that what is inflation adjustment? So annually, IRS have to adjust it to prevent the taxpayer from the bracket creep. What is that? What does we mean by bracket creep? So as we know that the each and every year inflation will be increasing, so the bracket creep is where the inflation pushes the taxpayer into the higher tax brackets. So this prevents the taxpayer from being pushed into the higher tax bracket, and that's why IRS has to adjust the rates as per the index for inflation. So here's a quick glimpse on the eligibility criteria. So for 2025, the single filers can take the standard deduction of $15,000. In the prior year, it was 14. The joint filers can take $31,500. In the prior year, it was 29,000. And for the head of household, it is $23,625. And for the prior year, it was 21,900. So as you can see, which I just now explained, that in comparison to the prior year on the right side, the 2024 amounts, the current year will be now for us is 2025 taxes, which will be filing in the year 2026. So these amounts are increased in comparison to the prior year. Another interesting fact is that the OBBBA makes permanent these temporary increases, which used to happen each and every year in the standard deduction. So why we say this as a permanent increase? So had this not been permanent, it would have defaulted back down to $6,500 for the single filer, $13,000 for the MFJ, and 9,550 for the HOH before indexing for the inflation. So that's why this OBBBA Act is helping the taxpayer by increasing the standard deduction. Another important update, we all know that when the returns are filed separately, then the both spouses must elect the same method of deduction, either standard deduction or the itemized deduction. So next on the exclusion part, this is already in comparison to the prior year, it's the same, where we can see that the following taxpayer they are not eligible to claim the standard deduction. We try to include this slide to make sure that we are on the same page. We already know that the non-resident aliens or the dual status aliens, they are not eligible to claim the standard deduction. The individuals filing a return for less than 12 months and the taxpayers who have claimed itemized deduction on the spouse separate return, they cannot claim the standard deduction. Here on the slide deck, we have the standard deduction or the itemized deduction where it will come on the form 1040. This is 2024 1040, and for 2025 it might change. So we are still awaiting from the IRS updates on that. Here's a quick glimpse on the standard deduction where we are comparing for tax year 2025 versus 2026. And here also, as I said before, we can see the above deductions, they are adjusted for the indexation purpose. And the amounts in comparison to the 2026, they are increased. So now I'll be focusing on the child tax credit. This is also a major update under the OBBBA Act. So what is child tax credit basically? Let's start with the basic. So child tax credit, it helps the families with qualifying children to take the tax break. So the taxpayer or the spouse, they may be able to claim the credit even if they don't normally file a tax return. And it's kind of a non-refundable credit that allows with the qualifying child to reduce their tax liability. And the child tax credit, it provides a credit of up to $2,200 per child under the age of 17 years. So if this credit exceeds the federal income taxes owed, the families may receive up to $1,700 per child as the refund. So that is the maximum amount which is refundable, and it is similar to the prior year. So the major update in terms of the child tax credit in the year 2025 is that the child tax credit limit is increased up to, we need to focus on the word up to, that it is increased up to $2,200 per qualifying child, whereas in comparison to the prior year, it was $2,000. So it's a good push by the Federal Tax Administration on the child tax front. They are increasing it by $200. Another update is that if your income or the modified AGI is $200,000 or less for the single filers and $400,000 or less for the joint filers, then the taxpayer don't have to do much in that case. The credit will be equal to the base amount, which is $2,200. I will be discussing on this part in detail in the upcoming slides where we have a proper matrix made for you all for your reference. So another interesting fact is in this case under the eligibility is that the other dependents, including the children who age between 17 to 18 and the full-time students aging 18 to 23, they can claim for the non-refundable credit of up to $500. And also the main thing out here in that the taxpayer and the child must have the social security number, and the credit will be reduced by $50 for each $1,000 of income over these thresholds. So what do I mean by that? So the credit, it will be reduced by $50 for each $1,000 of income over these thresholds. So it is $200,000 for the single and $400,000 for the MFJ. There is another concept which is known as the additional child tax credit. So basically, if the credit exceeds the income taxes owed, the taxpayer can receive up to $1,700 per child as refund, which is also known as the additional child tax credit, which is the refundable portion of the child tax credit. And the taxpayer in this case must have income of at least $2,500 to be eligible for the additional child tax credit. Here, under the exclusion, I have already discussed that the non-refundable portion up to $500 of credit for each child, it is limited to the taxpayer's child liability. So here we have a kind of a matrix which we have made for you. So through this illustration, we'll be discussing about on the child tax credit effect. I'll just discuss on the 1-2 points where you'll get a quick glimpse, quick gist of how the child tax credit works. And major thing out here we need to focus on is the bifurcation between the refundable and the non-refundable portion. Let's take a quick example of the filing status. Suppose the taxpayer is a single and the taxpayer's income under Form 1040, the modified AGI, is $190,000. The credit phase out amount is, as we know, $2,200, and the phase out starts with $200,000. So in this case, since the starting of this phase out and the taxpayer's income, the phase out start is more than the taxpayer's income, which is $190,000. So in this case, the phase out amount will be zero, and the taxpayer can claim the full credit of $2,200. But we know that this $2,200 cannot be fully refundable. Out of that $2,200, only $1,700 is the maximum refundable portion, and $500 is the non-refundable portion, which will reduce the taxpayer's tax due amount dollar for dollar. Interesting point here, as I discussed before also, that the credit reduced by $50 for each $1,000 of income over this threshold. We need to make sure on that. And likewise, you'll get to see the slide deck where you can understand under this concept only that how the other scenarios will work. In the next slide also, we try to deep dive into this child tax credit calculation, that how it is working. And through these two illustrations, you'll get to know that how the child tax works. Here, we try to give you the illustration through the tax forms of 2024, that if you want to calculate the child tax credit, then you have to file the Schedule 8812 form, where it is related to the credits for qualifying children and other dependents. There you need to update the details as per the line items. And interestingly, wherever you feel that these line items are not explanatory, you can always refer to the filing instruction. Those are very self-explanatory, and we can see that how this form works. And at the end, it is written that we need to enter that amount which got calculated and need to make sure that the amount flows to 1040 on the right side on line 19 as a child tax credit. Next, we will be discussing on the charitable contribution deduction. This is also one of the major updates under the OBBBA Act. As I said, that under this important update, it is for those taxpayers who are itemizing. So under the current law, cash contributions to the qualified organizations, the charitable organizations, they are deductible up to 60% of the individual taxpayer's AGI. Why the IRS is applying those kind of percentages or limitation? So IRS has to think for all of the population out there in US. So that's why these kind of thresholds or the limitations have been applied. If you would have focused on my words, I use the word qualified organization. What do we mean by qualified charitable organizations? So the qualified charitable organizations are those organizations who come into the ambit of 501c3 organizations. So there's a proper list under this where we can make sure if we want to make the charitable contribution, we need to go as per that, so that in order to claim the benefits of that. So it is saying that for the taxpayers who are claiming the itemized deduction will be allowed a deduction for charitable contributions, and there is no change in this from the prior year. It is lower of actual charitable contribution and the 60% of the AGI. So the interesting update out here for the year starting 2026 is that for taxpayers who want to claim the standard deduction, they can deduct the cash contribution of up to $1,000 for single head of household and the MFS, and $2,000 for the merit filing jointly starting 2026. So the OBBBA Act, it introduces this notable change for the non-itemizers. Who are non-itemizers? Those who are claiming the standard deduction. So also allowing the above the line deduction of up to, as I said, $1,000 for single and the $2,000 for the MFJ for charitable contribution beginning the year 2026. I already discussed on the eligibility criteria of contributing to the 501c3 organizations, and the acceptable recipients, it includes the religious groups, veterans, fire departments, and the civil defense. And under the exclusions, they are similar to the prior years. So there is no change into that which the IRS has made. And under OBBBA Act, there is no change into that. So majorly, I would say that this deduction reduces the gross income and is available to even those who claim the standard deduction. And it's kind of providing the modest incentive for the charitable giving individuals, regardless of whether they want to itemize or they want to standardize. So it's a very good thing which has been included for both of the itemizers and the standardizers. So a quick glimpse of on the form where we would be reporting if the taxpayer is making some charitable contribution. If the taxpayer is doing a non-cash charitable contribution over $500, we all know that it will be reported out here on the form 8283. And if it is a cash or if the gift is made of $250 or more, we need to make sure to report it on Schedule A under gifts to charity. Here is the summary of the charitable contribution deduction, which we have discussed majorly. You can have a quick look into it. Next, we'll be discussing on the moving expense deduction, which has been introduced in the OBBBA Act. The major update under the moving expense deduction is that it will be there on the actual basis only for the active duty members of the armed forces who move due to the military orders. And apart from that, this moving expense deduction is permanently eliminated for all other taxpayers. And this is the major change from the year 2024, which is now our prior year. And one another update is that this change in deduction will be there effective in the tax year 2026. So the eligibility criteria, as we know that the active duty military members, they must be moving under the official orders, and it also gets extended to certain federal employees and the intelligence workers. Exclusion, employer reimbursement for moving are the taxable wages and they'll not be deductible. Here's the form for moving expenses, Form 3903. This form is there for 2025. IRS has released that form. But if going forward, if there's any update or something, definitely please make sure to keep checking the IRS website for the most recent updates. And on the right side, we have the Schedule 1 for Form 1040, page 2. Line 14 is the one under the Adjustments to Income, Part 2, which will report the moving expenses for members of the armed forces. And for that, we need to attach this Form 3903. Next, I'll be focusing on the senior tax deduction, which the OBBBA Act very humbly increased the amount or updated the amounts on that. So OBBBA, it has introduced an enhanced deduction for the seniors, which allows $600 deduction for eligible individuals for tax years 25 to 2028. I would say that this new deduction is supplemental to the additional standard deduction that was already available to those who are 65 years and older under the pre-existing law, which is already there. So it's a kind of a new bonus deduction which has been introduced. And this deduction, there's an interesting fact I would like to focus on, that this deduction will be available to not just who take the standard deduction, but also for those who itemize in their tax returns. So who all basically will be eligible for this? So the senior deductions claim is determined by three factors mainly. It's like an individual must be 65 years or older by the end of the tax year to claim the senior tax deduction. Another thing is that it will be available for both the itemizing and non-itemizing taxpayers. And this deduction will begin to phase out when the modified AGI it exceeds $75,000 for the single or the head of household and $150,000 for the MFJ. So it's kind of the income limitation which is happening out here. And this will be fully eliminated if the income reaches $175,000 for the single filers and $250,000 for the joint filers. One update I would like to give under the exclusion that this deduction is kind of a temporary and it will be expired as the taxpayer reach the tax year 2028 unless the federal government extends it. And it will not be applicable or eligible for the merit filing separately taxpayers. That's a rule which is defined by the IRS. So here's a quick glimpse on the calculation for you all to properly understand what kind of deduction is this senior tax deduction. I'll quickly make you understand one example. After that, you will be able to understand what all scenarios are here. So suppose there's a single filer and that person is meeting the age test of 65 years and above, and the taxpayer's income is $70,000. As we all know that the phase out starts with $75,000 and the maximum senior tax deduction which the person can claim is $6,000. So since the taxpayer's income is less than the phase out limit, the phase out amount will be nil and the senior person can claim the final deduction of whole $6,000. We'll take a quick example, next example, where the taxpayer's income is more than the phase out. So in the next illustration, number 2, here the $90,000 is more than the phase out amount of $75,000. So how we can decide on the senior tax deduction amount? The difference amount between the income and the phase out is $15,000. We simply, what we have to do is we need to multiply it by 6% and the phase out amount will be calculated. Here the phase out amount will be $900 and then we can reduce that amount with the maximum senior deduction available, which is 6,000. So 6,000 minus 900, the final senior tax deduction will be $5,100. So similar to this, we can understand it's the self-explanatory grid. You all will be able to understand. And do let us know in case of any questions. As I said before, for the child tax credits also, we have included another illustration in order to make you understand this senior tax deduction in a elaborative manner. And here is the form. This will be reported on the form 1040 SR, and line 12 will be the standard deduction, and on line 12 it will be reported. Next, we have the individual tax brackets. We'll be quickly giving you the update of the OBBBA, that what all things have been included under the individual tax brackets. So the OBBBA, it retains the 7 existing tax brackets which are there from the year 2017 of the TCJA Act. And the top tax bracket remains at 37% with the income greater than $640,000. And the lowest rate is 10%, for the incomes of individual filers with incomes of $12,400 or less, and the double amount is $24,800 for MFJs. And as we know that each and every year IRS has to correct the amount by indexing it with inflation. So the additional inflation adjustment year for 10% and 12% brackets, they need to support the lower income taxpayers. Eligible criteria is remaining the same as per the prior years. It applies to all the individual taxpayers of all the filing statuses, and the adjustment, it will automatically be reflected in the annual IRS tables and no separate filing will be required in that case. So the exclusion in this case will be like the corporate tax rate will remain unchanged. The non-resident aliens, they follow the separate tax rate schedules in this case. So here is a quick glimpse on the summary of what all changes are there under the individual tax brackets. So that's all at this point of time from my side. So do let us know in case of any questions. Sharon, over to you.
Yeah. Well, thank you, Anil. That was a great perspective, and that gave us plenty to think about. So let's keep the momentum going. And I would like to call upon the floor Mr. Surya Bhushan Anand. And before he joins, so let me introduce uh, who is Mr. Surya. So Surya is the Director of Tax Operations at Global FPO, and he brings with him an impressive background, having held senior roles at leading international firms like Deloitte, PwC, and EY. With over 16 years of experience in US tax operations and compliance, Surya has a deep understanding of the evolving financial and regulatory landscape. We look forward to hearing his valuable insights and how these new reforms could reshape the way CPAs approach compliance and advisory services. So over to you, Surya.
Thanks, Sharon. Just give me a minute. Let me share my screen. Okay. Can you see my screen?
Yes.
Perfect. Yeah. So thanks, Anil, for such a brief explanation. Thanks
Surya.
to all the guest audiences and the entire Global FPO team for sticking with me through the upcoming section. It means a lot. All right, let's keep the momentum going and jump into the next part of our presentation. The upcoming topic, which I will be covering, would be auto loan interest deduction. So this is an interesting fact wherein this is something new which has been introduced under the OBBBA, and this will promote manufacturing or assembling of the vehicles in the United States. Again, this is new above the line deduction. What does this mean? This means the deduction is taken before figuring out your AGI, so you can claim it even if you do not itemize deduction. In simple terms, it directly reduces your income on the front page of your tax return, which can lower both your taxable income and possibly help with the AGI-based limits. So this is effective for the tax return 2025 until 2028. So individuals may deduct interest paid on a loan used to purchase a qualified vehicle. Again, what is interest paid? For the years this rule applies, a person can deduct the interest part of their car loan payment if the loan was used to buy a qualified vehicle. You do not deduct the whole car payment, only the interest portion shown on the loan schedule or from the lender. Only that portion is eligible for the deduction. So anything bought post December 31st, 2024 would be eligible for this deduction. So anything for 2025, 2026, 2027, and 2028. If you claim it, you can only do so for those years and only if you meet all the other requirements in the law. So in continuation with the slide, so new personal use vehicle assembled in the US. So what is this? So the car must be for personal use, not mainly for business, and it must be a new, not used. The vehicle must be built or finally assembled in the United States. So imported or foreign assembled cars will not qualify under this act. So what is the limitation over here? So deductible portion is up to $10,000 per year of interest on qualifying auto loans. So what does this say? You can deduct the interest you pay on a qualifying auto loan, but only up to $10,000 per year. If your yearly interest is more than that, the extra interest above that limit does not get a tax deduction. So what is qualified vehicle? And what we can consider for the qualified vehicle. So a qualified vehicle can be a car, a minivan, a SUV, pickup truck, or motorcycle, as long as it is under 14,000 pounds under the Act of Gross Vehicle Weight Rating, which basically means normal consumer vehicles, not heavy commercial trucks. The vehicle must also have its final assembly in the United States, meaning it is put together in a US factory. Loan must be secured by the car. The loan has to be a traditional auto loan where the car itself is a collateral for the loan. If you used a personal loan or a credit card to buy the car, the debt would usually not qualify because it is not secured by the vehicle. Now, income phase out rule. This deduction starts to phase out, get reduced, and then eliminated when your modified AGI gross income is $100,000 for single and $200,000 for joint filers. So exclusion part, what is covered and what is not covered. Vehicles that do not qualify. If the car is used, leased, mainly for the business, or imported, not assembled in the United States, then the interest on it does not qualify for this deduction. So the tax break is really only for new personally used vehicles built in the United States that you actually buy, not lease. So what is lease payments, which do not qualify? If you're leasing a car, your lease payments do not qualify for this deduction at all. Even if the part of your lease payment is considered imputed interest, it still does not count for this deduction. So again, there is a limitation over here. Deduction, this entire deduction gets expired in 2028 unless and until there is any new law which comes into picture. So this tax break is temporary and only applies through the end of 2028. So this is just a comparison slide wherein auto loan interest deduction, new personal use vehicle. So eligibility, yes, this is eligible for deduction if purchased and financed after December 31st, 2024. Secured auto loans qualify. Loan must be secured by the vehicle. Assembled in the United States. The vehicle must be built, finally assembled in factory located in the United States. If the final assembly happens outside the United States, the car will not meet this requirement even if it's sold by a US dealer. Income under $100,000 for single and $200,000 for married filing jointly. So what does this mean? If your income is at or below $100,000 for a single filer and $200,000 as a married couple filing jointly, you can take the full deduction if you meet the other rules. Once income goes above these amounts, the deduction starts shrinking and eventually disappears. Now, what is vehicle under 14,000 pounds, GVWR? The rule is aimed at normal light duty passenger vehicles, not heavy trucks. So typical cars, SUVs, minivans, pickups, and similar vehicles under 14,000 pounds gross vehicle weight rating are the ones that qualify. So does this deduction qualify for leased vehicles? No. What is leased vehicle? If you lease a car, you do not own it, so you cannot take this deduction on your lease payments. The rule only applies when you actually buy the vehicle and have a loan in your name. Business fleet or commercial use vehicles used mainly for business. Loans before January 1st, 2025. This is not eligible for deduction. Deduction after 2028. Again, this will get eliminated after 2028 unless and until there is any new rule comes up. So the next topic which I would be covering, that is taxes on overtime and tips. This is again another deduction introduced under OBBBA, applicable from January 1st, 2025 for the filing year. So this is applicable for employees and self-employed individuals. They may deduct qualified overtime and tips. So what does this mean? Both regular workers who get a W-2 and self-employed people who file Schedule C, etc., can use this tax break. If they have overtime pay or tip income that fit the rules, they are allowed to claim a deduction for it on their own tax return. Now, what is overtime and tips get federal income tax deduction? So for tax year 2025, 2026, 2027, and 2028, people can subtract certain overtime pay and tips from their income before calculating tax because it is an above the line deduction. They can claim it even if they do not itemize, and it directly reduces their taxable income. This helps reduce your tax up to $12,500 for single filers for overtime and $25,000 tips per year for both single and MFJ. So each year, a single person get a tax break on up to $12,500 of qualifying overtime pay. For tips, both single people and married couples filing jointly can take a tax break on up to $25,000 of qualifying tip income each year, as long as they meet the rules. So what is the limit? The limit which applies is $150,000 for single filers and $300,000 for married filing jointly. And this only gets applicable on your federal income tax return. However, for state, it doesn't qualify. So we have to be careful while filing the state tax return. So now taxes on overtime and tips and the exclusion. So some self-employed people work in what the tax law calls a specified service, trade, or business, such as certain professional, consulting, financial, or similar service fields. If a self-employed person is an SSTB, they cannot use this special tips deduction. Also, if someone is an employee and their employer is an SSTB, that employee's tips are not eligible for this deduction either. Tips and overtime. To claim the deduction for tips or overtime, the taxpayer must put their social security number on the tax return. If the taxpayer is married, they have to file a joint return with their spouse to qualify for this deduction. A married person filing separately cannot claim it. So this is only applicable for either a single filer or for married filer, and MFS people, they cannot take this deduction. Again, this is just a comparison map wherein what is eligible. So overtime pay, hours over 40 per week under FLSA. FLSA is Fair Labor Standards Act. So anything, so anybody working for more than 40 hours, definitely they can claim the deduction. I mean, they can, anything paid in as an overtime, they can take the deduction for that. And it is not eligible for state taxes. Tips, voluntary trips in tip jobs. So anything paid in mandatory service charges. So again, this is not considered, this is not allowed for the deduction. Income, again, the phase out limit is, the Maggie limit is $150,000 for single and $300,000 for MFJ. Anything above this will get phased out. So this is eligible for only the single and joint filers. However, for married filing separately, this is not at all allowed. for which year it's going to be covering. So it's going to be covering your 2025, 2026, 2027, and 2028. However, before anything for 2025 or anything after for 2028 will not be eligible. However, in case any future law comes up. So this is the form wherein you have to report. This is Schedule 1A for additional deduction. So Part 2, it's going to be for the tips. However, Part 3, it's going to be for the overtime. So the next topic is individual tax provisions under for the taxes on gambling. So again, this is something new wherein some amendment has come up in this. So gambling winnings were earlier also taxable. However, this is taxable again for the going forward years as well. So what is gambling winnings? Any money or prizes you win from gambling counts as income for tax purposes. This includes casinos, lotteries, sports betting, online betting apps, raffles, and so on. So starting tax year 2024, under the OBBBA Act, the gambling losses allowed is only up to the 90%. So what does this mean? Beginning with the 2026 tax year, you will no longer be able to deduct all your gambling losses. Instead, you can only deduct up to 90% of what you actually lost, even if your losses are higher than your winnings. So reporting and documentation requirements, yes, that has increased. The rules for record keeping and reporting gambling activity are getting stricter. Taxpayer will need to better proof of their wins and losses, like tickets, statements, logs, or casino records, and may have to report more details on their tax forms. So again, this applies to all US residents with gambling winnings. Anyone who lives in the United States and has gambling winnings has to follow these rules. It does not matter whether they gamble in person or online or in another state. What counts as a gambling winnings? Money you win from lotteries, casinos, sports, betting, and online gambling sites all counts as taxable gambling income. Prizes that are not cash, like a car or a trip, generally doesn't count. I mean, we have to consider the value of those into the dollar, and then we have to consider that as a winning. So for tax year 2025 and beyond, only 90% of your gambling losses can be used to offset your gambling winnings. So beginning with the 2026 tax year, you can use 100% of your gambling losses to cancel out your winnings. You are allowed to use only 90% of your total gambling losses to offset, reduce, or gambling winnings on your tax return. So for example, if you have made a winning of $18,000 as a win and then same amount as an loss also, so in this case, you can only deduct up to 90%, which is $16,200, meaning you would owe taxes on $1,800. So in this case, 90% of 18,000 losses would be 16,200, and your winning is 18,000. Since the only limit which is allowed is 90% of your losses, so in this case, 1,800 still is an income, and you have to report that on your tax return, and that will be reported as a income. So gambling losses cannot exceed winnings. You can never claim more gambling losses than the amount you won. So even if you lose a lot more than you win, for tax purposes, your gambling loss deduction is limited to the total of your gambling winnings for the tax year. Casual or informal bets with family, friends, usually not taxable. Sorry, 1 minute. So anything as in small friendly bets with family or friends, like betting on a game for fun, are usually not treated like regular reporting gambling, unless they are large, organized, or part of a business like setup. These casual bets typically are not taxed or formally reported. So again, this is the form wherein this is W2G, wherein all your winnings and losses would get reported with all the transaction details. And in case you get any kind of scenario, so we need to be more specific in terms of asking additional questions about the documents. So again, this is just a comparison thing. Gambling winnings, taxable and must be reported. Gambling losses, deductible only up to the amount of reported winnings. Lotteries, casinos, sports bets, included under OBBBA rules. Online gambling, yes, this is included. Non-resident aliens, not eligible. They are not eligible for deduction. However, any income they make, they have to report it on their tax return. Losses exceeding winnings, not deductible. Casual informal bets, generally not taxable. State and local tax treatment, not affected by OBBBA. So under the new OBBBA rule, this is not deducted. I mean, it is not impacted. So the next topic I would be covering is a state and local tax deduction. So state and local tax, in simple terms, it also called as SALT, allows taxpayer who itemizes to reduce federal taxable income by the amount of state or local taxes paid, income, property, sales. Historically, this deduction was unlimited, preventing double taxation. The Tax Cut and Jobs Act, TCJA Act 2017 capped it at $10,000. So before 2017, basically the entire state and local taxes paid used to get deducted on your Schedule A as a deduction, itemized deduction. However, after 2017, this rule changed and the limit which was capped was $10,000 for MFJ and $5,000 for single filers. So what are state and local taxes? Basically, government collect taxes, fees, and license for community services. State taxes, they fund schools, law enforcement, health services, and local taxes fund local schools, police, fire, sanitation, etc. SALT deduction, what is SALT deduction? SALT deduction allows deduction of state income or sales tax plus state local property taxes. Under the new rule, under the OBBBA Act, this has changed. For single filer or MFJ, married filing jointly, the SALT deduction limit has increased to $40,000. Earlier, it was $10,000 for MFJ and $5,000 for single filers. For married filing separately, it becomes $20,000. However, until 2024, it was just $5,000. And to index this up under the OBBBA Act, so every year there would be an increase of 1%. So for example, under the new OBBBA Act for 2025, if you are able to claim $40,000 as an itemized deduction under the SALT taxes, so that limit will get increased by 1%. That would be, so for 2026, the same limit will get increased to $40,400. So you must itemize deduction to use the SALT cap. This bigger SALT cap only helps if you itemize on Schedule A instead of taking the standard deduction. So if you take the standard deduction, you won't get any kind of benefit out of this. But if you claim the itemized deduction, definitely you're going to get the benefit out of this. So full 40,000 cap applies only if your modified AGI income is less than $500,000 for joint and single filers. So again, this is a new thing. The limit remains same for single and married filing jointly filers. So if your modified adjusted gross income is above $500,000, the allowed SALT deduction starts dropping and can move back toward the old $10,000 cap. For married filing separately, the threshold is $250,000 for 2025. If you're married and file separate tax return, you only get the full SALT benefit if your Maggie is $25,000 or less. So here is a scenario. If Maggie threshold cap is reduced by 30% of income above threshold, when someone's income is over the limit, they start to lose part of the higher SALT cap. You take the amount over the threshold and multiply it by 30%, and that number is how much you knock off the cap. So you can see this example wherein 550K is the Maggie. However, the limit is 500K. So this is in addition of 50K, wherein 50K is multiplied by 30%, which gives the reduction in your cap limit of 40,000. So after the deduction, the limit what you can claim on your tax return is only $25,000. Again, where do we report this? So this gets reported on your Schedule A under the line 5. So this is just a sheet wherein pre and post changes has been reflected over here. So pre 2025, the SALT deduction cap was $10,000 for MFJ. However, for MFS, it was $5,000. Post OBBBA Act, the limit has gone up to $40,000 for single and married filing joint filers. However, for MFS, the limit is $20,000. High income phase out, none pre 2025, but for 2020 post 2025, anything above $500,000 will get reduced by 30% of excess income. Deductible taxes, state and local income, property sales, this is pre-OBBBA. However, for post-OBBBA, it remains the same. It's remained the same, but the cap has increased. Duration, the earlier act was permanent. However, for post-OBBBA Act, this is temporary. This is for 2025 tax year, 2026, 2027, 2028, and 2029. However, post that, it will revert back to 10K for MFJ filers and 5K for single filers, unless and until there is any update from the IRS. Itemization in both the cases, yes, you can itemize. So this is just a summary of what we have discussed so far, including Carl and Anil. The standard deduction limit pre-OBBBA was $15,750 for single filers. For married filing joint filers, the limit was $31,500. However, post-OBBBA Act, the limit has changed to $16,100 for single filers and $32,200 for married filing jointly. Child tax credit, earlier it was $2,000 per child. However, as per the new OBBBA Act, it has increased to $2,200 per child. Again, indexed inflation, starting phase out at $200,000 for singles and $400,000 for joint filers. Charitable contribution deduction available only for itemizers. However, post-OBBBA Act, above the line deduction up to, so this is in addition to either itemized or standard, you can still claim this amount as an deduction. I'm so sorry. Moving expenses, it remains almost the same only for the military people, and there is no major change in OBBBA Act. Senior tax deduction, earlier it was not there. However, for 2025 tax return and on, this is applicable, wherein, over any deduction, you are eligible for 6,000 of additional deduction for age 65 and above. This was explained by Anil. Tax bracket, again, for pre-OBBBA Act, the tax bracket was same as TCJ Act. For 2026, it remains the same. The highest tax bracket is 37%. For single filer, it is the limit is $640,000 for single filers and $700 for joint filers. Auto loan interest deduction, this is something new which has been introduced under the OBBBA. So pre 2025, it was not at all there. However, for 2025 onwards until 2028, definitely this is there. And the limit, the maximum limit for this is $10,000. Taxes on overtime and tips, there was no preferential treatment. However, for 2025 and post 2025, the partial exclusion deduction allowed up to set limits to 2028. Taxes on gambling, not a major change, but yeah, before 2025, the entire deduction up to the winning, it was allowed. However, for post OBBBA Act, only the 90% of losses can be taken as a deduction. State and local taxes, again, there is a major change over here. Pre 2025, the limit was only $10,000 for MFJ and $5,000 for single filers. However, for post OBBBA Act, the limit has increased to $40,000 for single and MFJ and $20,000 for merit filing separately. Again, there is a phase out limit gets applicable over here. So we have to be mindful while we consider these things while doing the tax return. So for further presentation, I would like to invite Anil and he can take it forward. Thank you so much, everyone.
Well, I would like to jump in here. So thank you so much, Surya, for sharing such thoughtful and practical insights. That was an excellent overview. And before we move to the next segment, we'll take a quick 5-minute break. Please feel free to stretch, grab a cup of coffee because we have another 1 hour to go. And we'll resume right on time, so don't go too far. We have more valuable insights coming up right after the break.
Thanks, Sharon.
So, as promised, we are back on time. So, welcome back, all the attendees. So, Anil, I guess we are good to go.
We are good to go. Thanks so much, Sharon. I'll take it from here.
Yeah.
So I hope everyone got some time to take the break. And thank you so much for attending this session. I'll be now discussing on the specialized tax provisions under this OBBA Act. Under this, I'll try to give a quick glimpse only on the gift tax. With this, you'll get to know that the Global FPO, me and my tax team, have robust experience, not just in our individual taxation or business taxation, but also we have good experience in the gift tax. So before jumping into the gift tax updates under the OBBA Act, I'd quickly update you that what is a gift tax? So a gift tax is kind of a tax on the transfer of property by one individual, which is the taxpayer, to a donee, in which that person doesn't receive anything in consideration, which means doesn't receive anything in return or less than the full value in return, which means that there should not be anything in return in consideration. Then only it will be termed as a gift, and the tax applied on that gift will be termed as a gift tax. So the major update under here is that the IRS has increased the amount of annual exclusion in comparison to the prior year. In the prior year, it was $18,000, and now in the year 2025, it will be $19,000 per person or donee. So if the person is donating up to $19,000 per person, that person can escape the filing of the gift tax return, but still there are certain riders on it. Another major update is that for the year 2025, the lifetime exemption, I'm especially focusing on this word lifetime exemption, it is $13.99 million. And this exemption amount is scheduled to increase in the year 2026 from 13.99 to $15 million. So basically, this lifetime exemption, in this, the IRS allows a person to give away up to $13.99 million in assets, cash, or property over the lifetime of the person. So for 2026, the lifetime exemption increases to $15 million per person. Here is the eligibility criteria, which is unchanged from the prior years. So majorly gift tax applies to only the US taxpayers, majorly. And the tax rate remains unchanged at 40%. And the filing requirement, if the amount is above the annual exclusion, which is $19,000, that person have to report that gift to Form 709, which we must ask our clients each and every year. There are certain exclusions which remain unchanged in comparison to the prior year. So there is no change in the annual exclusion mechanism, the way it is increasing each and every year. Prior year it was $18,000, current year it is $19,000. There is no reduction in the exemption after 2025. The OBBA removed the sunset of the TCJA Act. The state level gift taxes, it may still apply depending upon the states which we are filing with the federal tax return. And the non-US persons, they are subject to different limits and the reporting rule on the gift tax return. So for gift tax, we file Form 709. This is the 2024 tax form. 2025 will be released shortly by the IRS. On this form, we have to report the gifts, and there are multiple parts into this. Here's a quick summary of the things which we have discussed before, defining the category and the eligibility rule. So That's all from my side. Again, my name is Anil Bhatia, and me and my counterpart Surya, we are the tax directors out here at Global FPO. Over to you, Sharon. Thank you.
All right. Thank you so much, Anil. So, I think we are now open for Q&As. So please continue to send them through the Q&A box.
So, hi, Oren, I can take your question, which you have posted in the chat group. That is Salt Maggie. What are the modification to AGI? So again, pre-OBBA Act, only 10,000 of deduction was allowed, regardless of income. However, under the new OBBA Act, the limit has changed to $40,000 for single and MFJ filers, and for MFS, it is $20,000. The phase-out limit starts from $500,000 for MFJ and single, and for MFS, it is $250,000. So hope I answered your question over here. In case of anything else, definitely you can put it in the chat window and I can take it forward. Thanks, Jamie, for your feedback over here. Then I can take the another question over here. Is there a way to count this for CP credits? For now, definitely, it's not possible now, but we are working towards that. And for future, definitely we can consider this and it will be allowed for a CP credit.
So I'll be taking over the last question out here, which is saying that do we pay gift taxes on the amount that is over the annual threshold? So as I said, that even if the amount of $19,000 of annual exclusion, if the person has donated the amount way above the $19,000, suppose $20,000 of the amount the person has gifted to the donee, this amount is above the $19,000 limit. And how much it is above? It is $1,000. So this amount will be reduced from the lifetime exemption of $13.99 million. And the remaining lifetime exemption will be whatever the difference of the 13.99 million with $1,000, and the person don't have to pay the tax of 40% on the gift taxes. So I hope I have answered the question. So that's the anonymous attendee who has asked the question. So we don't have to pay the gift taxes, even if the amount is over the annual exclusion amount. So if there are no other questions, then we would like to give you back the remaining timing of your precious time. Over to you, Sharon. Thank you.
Yeah, well, it looks like we have covered all our key discussions a little ahead of schedule and efficiency at its best, I would say. So, that brings to the end of today's session. And I would like to thank to all the audience and all the speakers on the behalf of Team Global FPO and 40 Accounting, and all of you for being such an interactive audience. So we hope today's session gave you some useful takeaways. And if you have any additional questions, so feel free to reach out to us. We had be happy to continue the conversation. And thank you once again for being part of today's webinar. And we look forward to seeing you at our next series of webinar. So until next time, stay safe, stay inspired, and have a wonderful day ahead.
Thanks, Sharon. Thanks, everyone.
Thanks, Sharon. Thanks,
Thank you
Surya.
so
Thank
much,
you,
Anil.
everyone,
Thank
for
you,
attending.
Surya.
Thanks, Anil.
Anytime. Bye.
All right. So I think we can wrap up now.
Yes, we can. Thank you so much.
Okay, thank you.